Hello and welcome. Today we are diving deep into the Grow Nifty India Defence ETF FOF. And to delve deeper into this fund, I'm joined by Sneha Suri, lead fund analyst at Value Research. Welcome, Sneha.
Thank you.
Sneha, to begin with, could you tell us why India's defence sector has been in the spotlight, has been gaining so much attention lately?
Right, and that is the most frequently asked question by investors as well. So the government's flagship Make in India initiative has been the major driving force. Alongside this, the Atmanirbhar Bharat initiative that has been going on. Together, these two have been promoting the local manufacturing in the India's defense sector. Another point being that there is an increased defense budget that the government has been pushing, along with growing opportunities in defense exports where ambitious targets have been set for the coming year. So all in all, these are the reasons for, the rising interest in this sector.
Right. Now, moving on to this particular fund, can you please explain what is the investment objective of this fund?
Right. So as the name suggests, this is a fund of fund structure, FOF, which means that it invests in another fund. Here, the fund being an exchange traded fund, ETF. The ETF in turn invests in an index. Here, the index being, as you mentioned, Nifty India Defence Total Return Index. So the Grow Nifty India Defence ETF FOF is a passive fund designed to replicate the performance of this particular index that I mentioned, and that being the primary objective, to generate returns which align with the performance of this particular index.
All right, now since this fund tracks an index, let's dive deeper into that. Can you please tell us what companies constitute this index and how are they chosen?
So first of all, this Nifty India Defence TRI was launched around January 2022. So it is a pretty recent index that we have. And currently it is home to 15 companies that broadly represent the defence sector. To name a few, these would be Bharat Electronics, Hindustan Aeronautics, Zen Technologies, and we have 15 of them. So companies in this particular index are selected from a broader Nifty total market index, which has 750 stocks. So you have the first 500 stocks and the 250 included in the 750. And to qualify, a company broadly has to earn a revenue of at least 10% from the defense sector. Then it will become part of this particular index, the Nifty Defense Index that we're talking about. And the selections are based on the average market cap over the last 6 months of the stocks that qualify for this index. Currently, the top 10 companies comprise of a significant 94% of the portfolio, with a maximum cap of around 20% on a single stock. Coming to the market cap allocation that the index boasts currently, so you have large caps of around 45%, and mid and small would be comprising of about 58%. On the rebalancing part, the index is adjusted every 6 months, somewhere around March and September.
All right. Now, since we're talking about this index and you mentioned that it was recently launched in 2022, how has it performed in comparison to the broader market?
As I was mentioning in the beginning, the Make in India initiative has actually fueled a rally in this particular index, with the index doubling in value over the last 1 year as of August 31st, 2024. Now, many defense companies, mainly the government-owned PSUs, have seen their stocks rise to next level, if I can say that. Now, while I mentioned that the index was launched in 2022 January, the base date that has been given is April 2018. So we do have 3-year rolling returns for this particular index available. And if we map, the index has significantly outperformed the broader market, nearly 4 times that of the broader indices.
All right. Now, to wrap this up, if you could tell, who do you think is, should consider investing in this fund, and what kind of risk profile is best suited for this fund?
Okay, so let's say if you're confident that the defense sector is the next big thing, in that case, just ensure to take a cautious and long-term approach. So what can be done here is you can set a target allocation and decide how much allocation you can have to this particular fund, so that you don't get all in at once. Along with that, one can ensure to not invest in a lump sum, not a one-time investment. SIP would be better, a monthly SIP, let's say, because this way you'll avoid catching a market high if it so happens. Now, given that it is an equity fund, a long time horizon of at least 5 years should be considered, and a higher risk profile would be better.
All right, then. That was all about the newly launched Grow Nifty India Defence ETF FOF. Thank you, Sneha, for sharing valuable insights.
Welcome.
Thank you.